variety in the size of mutual funds in India. The assets under management or AUM of the Indian mutual fund industry varies from 10 crores to 50,000 crores. If the AUM of any fund is high, it means that a larger number of investors are engaged in it. A lower AUM indicates that investors are less interested in that particular fund. There are many funds that have the advantage of a better track record and risk-return aspects despite a low AUM. A high AUM does not necessarily guarantee a better performance.
In order to understand this concept, it is essential to learn about the AUM of mutual funds. Is it the only criterion by which it can be determined whether a fund will yield good returns or not? AUM is the total market value of investment managed by a mutual fund scheme. In other words, it is the total amount of money that a mutual fund invests on behalf of its customers or investors. For instance, if any investor invests 50,000 rupees in any mutual fund, it is part of the total AUM of the fund. The fund manager of the scheme is responsible for investing and managing this AUM on behalf of investors in shares or other securities in accordance with the fund's investment objectives. This is done for the purpose of increasing the total value of investment. Hence, the market value of the total investment of a fund on any given day is known as its AUM.
Let us now see if the AUM of a mutual fund has any impact on its return. Let us first understand about the working of an equity mutual fund. It is a fact that the AUM of an equity fund has a low impact on its return. The size of the stock market in India is large, due to which the AUM of equity funds is also often of considerable value. A greater value of AUM indicates that the fund is performing well. However, it is no guarantee that the fund will continue to perform well in the future as well. It is not advisable to dismiss any scheme solely because the size of its AUM is of a lesser value.
For example, the AUM of Axis Blue Chip Large Cap Fund is 32,615 crore rupees, whereas that of PGIM India Large Cap Fund is 432 crore rupees only. The majority of investors will invest in Axis Blue Chip Fund on the basis of the value of its net assets. However, if we take returns into consideration, then PGIM India Large Cap has yielded a better return in 1 and 3 years. The AUM holds significance in small cap equity mutual funds. This is because small cap funds invest in small cap shares. There is a possibility of growth in small companies. However, at times, such small companies struggle due to paucity of funds. Small cap shares are less liquid as compared to mid cap or large cap shares. Whenever there is a fall in the market, redemption increases in the fund of small caps that have a value of 100 to 50 crore rupees. Due to this, the fund faces a shortage of cash. In such a situation, it is not easy for the fund manager to sell the shares in order to cover the withdrawal amount of investors. In other words, NAV falls, causing loss to the investors.
If we talk about debt funds, then the AUM or size of funds hold some significance. The advantage with debt funds having a higher AUM is that investment in them is less, as the expense ratio of a big fund is low. They can invest a larger amount of money as compared to a small fund. Debt funds with significant assets are in a better position to negotiate better interest rates with debt issuers. This translates into better returns. However, there is one problem with large debt funds. It is difficult to liquidate them or withdraw money in times of need. If the debt market is liquid and the funds need cash inflow, then it is not easy to gather funds.
Let us take the example of the Franklin Templeton debt fund crisis of 3 years ago in April 2020. The fund house had to close 6 debt fund schemes due to the challenges faced in selling its debt fund securities. This helps us understand the fact that the size of the AUM is not always of sole importance. Parameters such as the level of liquidity are also significant in debt securities. The size of AUM in some funds does offer an advantage, but only to a certain point. Hence, investors must keep some factors in mind while choosing any fund for investment, such as the efficiency and competence of the fund manager and his team, the track record of the fund house, and the process followed by it in choosing shares or other securities. Before investing in any fund, the investor must understand its track record, expense ratio, reliability, the correlation between risk and return, etc. If you're investing in mid-cap or small-cap funds, it is better that the size of its AUM should be neither too large nor too small. Similarly, if you're choosing between flexi-cap, large-cap or fixed-income funds, then ideally, merely the size of their AUM holds no significance.
Last, the fund house and the fund manager are important factors in any mutual fund scheme. Many small funds yield good returns and in future progressively grow into larger funds. Many funds started on a small scale but grew rapidly in size as the awareness or publicity of their success story increased among investors. It is advisable for investors to invest in mid-sized funds and schemes having strong professional parameters. Investors must keep in mind that while choosing any fund, its expense ratio, benchmark, exit load, track record of the fund manager, etc. are also important factors.